So the first question is a very typical Chapter 10 question where we give you some information about a business owner. So in order to keep the analysis very straightforward, all business examples that we work in with Chapter 10 is a sole proprietor. So it's a single business owner. And the reason why we typically use these examples is because it means we only need to take into account that one individual's implicit costs of starting a business. So we have Sheila, who starts a sports shop that has an annual revenue of 600,000. She runs the business herself. Her alternative employment options are to work as a swimming instructor at a university for 50,000 Rand or as a construction worker for 40,000 Rand per year. Sheila spends 230,000 purchasing goods for resale. She also has 4 employees who each earn 25,000 per year. She owns the building that her shop is housed in, which she could have rented out for 20,000 per year. Sheila's economic profit for the year is equal to what? So the important thing to know about economic profit is that it takes into account both explicit costs and implicit costs. When we add these two together, implicit costs and explicit costs, we end up with opportunity cost. So economic profit is going to be total revenue minus total opportunity cost. Something that can confuse students is they think about opportunity cost as only an implicit cost. Opportunity costs are both explicit and implicit because it's the value of the entire opportunity. So if she didn't do this business, she would have had all the explicit cost money that she spent to have used for something else, and she would have had all the implicit cost money that she gave up as well. So the entire value of the opportunity foregone are the explicit and the implicit costs. So in this example, the total revenue is given to us. We don't have to calculate it. So it's 600,000. Her explicit costs include the 230,000 Rand that she spends on stock, as well as the 100,000 Rand that she spends on employees' wages. So those are her explicit costs. Her implicit costs are the rent that she has given up because she could have rented out the building that she is utilizing for 20,000 Rand per year. And it is the 50,000 Rand that she gave up as working as a swimming instructor at university. So the trick to this question is knowing that she had 2 alternatives available to her instead of starting the sports shop. So the only one that actually counts as an implicit cost is the highest valued one. So if we want to figure out what are the skills that she possesses worth, it has to be valued according to that opportunity which gave her the most income. So the only value that we take away in terms of salary foregone is the swimming instructor salary. Okay, so that was meant to be a negative because it's a cost. So in the end, she's making an economic profit of 600,000 minus 230,000, which is 370, minus 100 is 270, minus 70 is 200,000 Rand. So she is making an economic profit of 200,000. So the answer to this question is going to be answer B. Okay. So the values that we have here, typically we could choose values that you maybe would get if you had made a mistake in choosing your explicit and implicit costs. But looking at these values here, even if you made some mistakes, it's highly unlikely that you would end up at any of these other values. So yeah, this is a very straightforward question. If you use the right values and you subtract all the right costs, then you should get an answer of 200,000 Rand. Okay. Something that does come up in these questions, which I just want to point out, is that in the past we've mentioned that there is a cost of purchasing equipment. I just want to remind everybody that equipment cost does not form part of your profit and loss calculation except in the form of depreciation. So if the question tells you the person spent 200,000 Rand on equipment, you wouldn't subtract that 200,000 Rand as a cost. What you would subtract is the depreciation on that equipment, which would be the market price paid less the current market price. So if we told you that the individual bought the equipment for 200,000 Rand, and at the end of the year they could have sold it for 170,000 Rand, that means depreciation would be 30,000 Rand. This question helps to differentiate between what economic profit is, what accounting profit is, and what normal profit is. So the difference between these three things comes down to which costs you are accounting for in your profit calculation. So if you take total revenue minus only your explicit costs, you will end up with accounting profit. If you take away from accounting profit, so let me say accounting profit less implicit costs, which include normal profit, okay, because normal profit essentially gives you an indication of how much profit you should expect to earn in this industry. So once you have accounting profit, you take away all your implicit costs, including normal profits, and that will then give you your economic profit. What this means is that when your economic profit is zero, it means that after you've accounted for explicit costs and implicit costs, including normal profits, that means that you are making exactly normal profit. So making exactly normal profit is the same as making zero economic profit. If you make positive economic profit, it means you're making more than normal. If you make an economic loss, it means you're making less than normal. And that makes sense, because if after you've taken away your explicit and implicit costs, and then you also take your normal profit away, and you're left with a positive value, it means that the normal profit wasn't enough to eat away at all the profit you've made. So you've made something additional over and above normal. If after taking normal profit away, you end up with a negative value, it means that what you had after all the explicit and implicit costs was less than normal. So in terms of this question, if economic profit is equal to zero, then the entrepreneur's accounting profit is also equal to zero. That can only be true if there are no implicit costs. Okay, so if we knew that there were absolutely no implicit costs, of which we know it's highly impossible, that is the only way economic profit and accounting profit would be the same. And that would be synonymous with saying that normal profit is zero. So in other words, if economic profit and accounting profit are both zero, that means there are no implicit costs, and the normal profit of this industry is zero profit. So that kind of makes A very wrong. So A is wrong. If economic profit is equal to zero, then the entrepreneur's accounting profit is less than zero. If your accounting profit is less than zero, it means you're making a loss in accounting terms. If you now additionally take away implicit costs, including normal profit, you'll end up with a value that is even more negative. So it can't possibly be the case that if economic profit is zero, your accounting profit is negative. Because if accounting profit is negative, it means your economic profit has to be negative as well. If economic profit is equal to zero, then the entrepreneur is earning only a normal profit. So that is correct, okay? Because once you've taken away all your explicit and your implicit costs and your normal profit, and you end up with a value of zero, it means that your economic profit is normal. You are making normal profits of your industry. And then D, if economic profit is equal to zero, then normal profit is negative. That can't be true, because if your normal profit is negative, then essentially the profit of the industry will be negative, and that will automatically take you into an economic loss. So D can't be correct either. So the important thing to remember here is that we can define economic profit according to normal profits. If net economic profit is positive, you must be making, this means you are making more than normal. If your economic profit is negative, this would mean that you are making less than normal for your industry. And if economic profit is 0, this would mean that you are making exactly normal profits. Okay, so that's why when we talk about normal profits, we also talk about it as 0 economic profit or break even. Basically, your revenue and your costs, which include explicit and implicit costs, balance out. Case and bond take out R1 million. So I'm going to write it up here. So case and bonds withdraw R1 million from the bank, and that R1 million could have earned interest of 8%. Okay, so that means by drawing that money out of the bank, they have given up 80,000 rands worth of interest. So that is an opportunity foregone. That is an implicit cost. Okay. They also then said that that 1 million rand is used for equipment and stock. And then further in the question, they tell you that the equipment costs 200,000 rand, which then means that the stock must have cost 800,000 rand. So in this example, the 200,000 rand wouldn't come in as a cost because it's an equipment cost, but they do tell you that it has a current market value of 170,000. So that means there would be a depreciation of 30,000 rand. So the 200,000 rand wouldn't be a cost, only the 30,000 depreciation. The remaining 800,000 rand that was spent on stock would be a cost. That would be an explicit cost. So in that question, the R1 million has a few costs attached to it. It has a cost in terms of interest foregone. It has a cost in the form of stock, which is explicit. And then it has another implicit cost in the form of depreciation. So in these questions, it's very important to read carefully to know which values need to be used in answering the question. So the last concepts from chapter 10 are these two concepts of technological and economic efficiency. So the definitions of these two terms is technological efficiency means that you are using least inputs to produce a given quantity. So technological efficiency is when you use the least amount of inputs to produce a given quantity, whereas economic efficiency means that you are producing a given output at lowest cost. So the important thing to know with regards to these two concepts is that technological efficiency does not guarantee economic efficiency. And the reason why is because you could be using least inputs, but you could be using a very expensive input. So a method that uses a lot of capital and a little amount of labor could be technologically efficient relative to a method that uses a lot of labor and a little capital. However, depending on the relative cost of labor and capital, one of those will end up being economically inefficient. So technological efficiency does not guarantee economic efficiency, but if a firm is economically efficient, they will be technological efficient. So if a firm is economically efficient, then it has to be the case that they are economically efficient. If a firm is economically efficient, it has to be the case that they will be technologically efficient. But if a firm is technologically efficient, it doesn't guarantee that they will be economically efficient. The one thing we also know is that if a firm is economically inefficient, it has to be economically inefficient. So technological inefficiency guarantees economic inefficiency. Okay, so in this question, what they tell you is that if a firm chooses to produce 100 units of output with 10 units of labor and 12 units of capital for a total cost of 150 Rand, when they could produce the same 100 units with 10 units of labor and 8 units of capital for a total cost of 120, the firm is technologically what and economically what? So they're making 100 units with 10 labor and 12 capital. They could have used the same amount of labor, but 4 fewer units of capital to get the same output. So that means they're currently technologically inefficient because they're currently using more inputs than they could be using. So they're definitely technologically inefficient. And if they're technologically inefficient, they have to then be economically efficient, because you can't be technologically inefficient but economically efficient. So the answer is D, inefficient on both counts. Okay, so B can't possibly be correct because you can't be technologically inefficient and economically efficient. You can be technologically efficient and economically inefficient, but as the question establishes, they're using more inputs than what is necessary to get the same output. So they're not technologically efficient, and therefore C is also. So a typical past paper question that we've had is where you have different methods that use certain amounts of labor, certain amounts of capital, and they both achieve the same level of output. So you can have method A, which let's say uses 10 units of capital, 10 units of labor and 100 units of capital, and the output is 100. Method B uses 100 units of capital and 10 units of labor, and it also achieves an output of 100. And then you have a method C, which uses 20 units of labor and 120 units of capital, and it also produces 100 units of output. If the question was which of these methods is technologically efficient, and which ones are technologically inefficient, what you need to do to answer that kind of question is you have to compare every method to all other methods. So if we compare A and B, we see that A uses less labor than B, but it uses more capital than B. What that means is that we can't actually judge these two relative to each other, because the one is utilizing minimum labor and the other one is using minimum capital. So in comparing these two methods, we actually cannot say whether one is technologically inefficient or not, because they are both appearing to minimize the use of one particular type of resource. If we compare A and C, we see that A uses 10 labor, C uses 20. So C uses more labor than A. And C also uses more capital than A. So what we can see from this is that C is using more of both inputs and achieving the same level of output. So you can almost think of this as C has 10 redundant units of labor and 20 redundant units of capital, because it's using that extra inputs but not really getting anything out in terms of output. So if I compare A to C, C is technologically inefficient. And once a method is proven to be technologically inefficient compared to just one other method, it is technologically inefficient, because why ever consider using C when A is an option available to you? But when it comes to A versus B, depending on whether you want to go labor intensive or capital intensive, A and B are both technologically efficient. If we then have to figure out well, which of A and B is now economically efficient, because remember, technological efficiency doesn't guarantee economic efficiency, then we need to know something about the cost of labor and capital. So if labor costs 10 Rand each and capital costs 50 Rand each, then method A would cost 100 Rand plus 5,000 Rand. So it would cost 5,100 Rand. And B would cost 1,000 Rand plus 500 Rand. So B would cost 1,500 Rand. So what we can see from this is that although both A and B are technologically efficient, B is the only one that is economically efficient because it achieves 100 units for less cost than A. And the reason why it's doing that is because labor appears to be more the relatively cheaper input to use than capital. So a labor-intensive production method is going to get a lower cost out of producing 100 units. So we're going to start with this question about total product, because this is where chapter 11 starts. It starts with this discussion that if you're in the short run, and what we mean by the short run is that one of your units of labor, or either your units of labor or your units of capital are fixed. So I'm just going to write that down so it's in your mind. So the short run is defined as a time period in which at least one of your inputs is fixed, and that is generally capital. The long run is then defined as a time period in which all inputs are variable. So in the long run, you can change your capital and your labor. In the short run, you're only able to change your labor. So if you're a business operating in the short run and you want to increase your total product, so you want to increase the amount that you're producing, because your capital is fixed, there is only one way that you can do this, and that is through increasing the amount of labor you employ. So only through increasing the amount of labor you employ can you increase your total product. So we can think of it this way. If you run a food, like a food wagon, so a food cart, and the space that you operate with is fixed, you have a limited space to work in, and it's not like you can double the size of your food cart very quickly. You have to plan, save money, make sure you can buy a bigger one. You are on your own managing this cart, and you're making food in this cart, and suddenly it becomes very popular and everyone wants to buy from you. And you realize that actually I have the capacity to produce more, but if I'm just on my own, I'm not going to be able to do this. So then you decide to hire another person who's going to help you increase your production. The thing that happens is that the minute you employ someone, you have to pay them. So the decision to employ somebody is the same as a decision to increase your total cost. You can't increase output without increasing total cost. So the whole point of chapter 11 is to link these two together, total cost and total product. And what we see is that when something happens to product, this will also reveal itself in cost. And when something happens to cost, it will also reveal itself in product. So when we have total product, in the beginning, you are just one person. So here's labor and here's total product or output. So total product and Q are representing the same thing. So in the beginning, if you have nobody working for you, so including you, you're not working, then you're producing nothing. Initially, you add a certain amount of output to your business. Then you hire a second person, and that second person is able to take over certain tasks in the running of your business. So when you introduce more labor into your business, you can start to specialize. So in the food cart example, you might then take over just dealing with customers and money, and the other person will cook food. So through hiring that person, you've managed to increase your total production, but at a rate faster than previously when you were the only person employed. So the marginal product of the additional person increases your total product. But what you can see is that your total product is then increasing at an increasing rate. So each additional unit of labor is adding marginally more and more output to your production process. But at some point, you start to hire people and they get in each other's way, because remember, your capital is fixed. And once people start getting into each other's way, they become marginally less productive. So then your output begins to increase, but at a decreasing rate. So every time you're hiring an additional person, true, they're adding output to your total production, but the additional output each additional person adds is less and less and less. So that's why we say total product is calculated as, sorry, not total product, your marginal product. I'm just going to delete that. So your marginal product is equal to the change in your total product divided by the change in labor. Okay, so marginal product is calculated as every time I change my labor, how does my total product change? So the steeper the slope of the total product curve, which is around here, so that's where your total product curve is steeper, that means that the marginal product of labor is larger. This is when your labor is becoming increasingly more productive. Once your slope begins to get flatter, so up here, that's when each additional unit of labor is becoming marginally less productive. So the steeper the slope of the total product curve, the larger the marginal product of labor. And that is because the slope of your total product curve is your marginal product. So when your total product curve is steep, your marginal product is high. When your total product curve is flat, your marginal product is low. Okay, so whenever we talk about the slope of the total product curve, we're talking about marginal product. Okay, so the second question then refers to diminishing marginal product. So in terms of this picture, what we mean by diminishing marginal product is once additional labor adds less marginal output to your total product. So when you're in sort of the declining slope part of your total product curve, that's when diminishing marginal product has set in. So in terms of the marginal product curve, how it looks is initially your marginal product goes up because people are getting more productive, but then eventually you result in diminishing marginal product and your marginal product begins to fall. So that's how your marginal product curve looks. So you have labor on the x-axis and you have marginal product on the y-axis. Okay, so diminishing marginal product is this. When as you employ more labor, marginal product begins to decline. So I mentioned earlier that marginal products or product and cost are related. The reason why products and cost are related is because if your labor is increasingly more productive, it means that they are increasingly more cost effective for you. If you think about it, if you hire a person and they cost 100 Rand and they make 10 units of output for you, it means that each unit costs you marginally 10 Rand. If you then hire another person also paying them 100 Rand, but they only make 5 units for you, they are costing you marginally 20 Rand per unit. So when marginal product goes up, marginal cost goes down. And when marginal product goes down, marginal cost goes up. So marginal products and marginal cost are the mirrors of each other. When the one is going up, the other one is going down. When the other one is going down, the other one's going up. Okay, so that's why cost is mentioned here, but we just have to check whether this cost answer makes sense with regards to diminishing marginal product. So it says diminishing marginal product suggests that marginal cost of an extra worker is unchanged. That is incorrect because if marginal product is going down, it means that marginal cost is going up. So A is wrong. B then says diminishing marginal product suggests that marginal cost of an extra worker is less than the previous worker's marginal cost. So that is incorrect because if there's diminishing marginal product, it means that the cost of an extra worker will be greater than the previous worker's marginal cost. Because if you are marginally less productive, you are marginally more costly. So B is incorrect. The only way B could have been correct if this had said an extra worker is greater than the previous worker's marginal cost. C then says diminishing marginal product suggests that marginal product of an extra worker is less than the previous worker's marginal product. Yes, that sounds correct. And the last one says that the marginal product of an extra worker is greater than the previous worker's marginal product. No, that is. Question 3. One of those big tables that look really terrifying because you see all these blank spaces and then you look at the marks and you think, oh my gosh, how am I going to do this? Fill in this whole table and I'm only getting 6 marks. Okay, I understand your pain. But know that you actually don't need all the information in this table in order to solve these questions. It's a matter of just knowing what information is necessary and what information isn't. The first thing you do with these tables is you try to figure out what fixed cost is. What you'll usually find is that fixed cost is hidden somewhere in the table. The usual place where it's hidden is here, okay? Because total fixed cost is the cost incurred even when you produce nothing. So fixed cost is the cost you have to bear even when you're not producing at all. It's something that is fixed, it's constant. So wherever quantity is equal to 0, so whatever, let me type that out rather as, whatever total cost is when Q equals 0, that is total fixed cost. Okay, so now we immediately know total fixed cost is 10. So that's information that you put down for yourself because that's going to help you with the rest of the question. So total fixed cost is equal to 10 Rand. Okay, the first part of the question then says, what is the marginal cost per unit if the firm moves from 14 to 17 cakes produced? Show all calculations. So the formula for marginal cost is very similar to the formula for marginal product. And there's a very good reason for why this is. So marginal cost is equal to, oh, that looks like a minus, equal to, doesn't look any better, the change in total cost over the change in quantity. So marginal cost tells us how has total cost changed when quantity changes. So that looks very similar to the formula for marginal product, which was the change in total product when I change my labor. This formula, change over change, is the formula for a slope. So when you're calculating a marginal value, whatever it be, a marginal value is simply the derivative or slope of the total value. So if we give you a total product function, you take the derivative, you get marginal product. If I give you a total cost function, you take the derivative, you get marginal cost. If I gave you a total utility function, you take the derivative, you get marginal utility. All marginal values are seen as change over change, which is a slope. And a derivative is basically calculating the slope of a function. So this is the formula for marginal cost. So the values we need to use for quantity are 14 and 17. So we're increasing our quantity from 14 to 17 cakes. And when we increase our quantity from 14 to 17 cakes, we increase our cost from 290 to 380. So our change in total cost is 380 minus 290, and we divide that by our change in quantity, which is 17 minus 14. So what we end up getting is 90 over 3. So the marginal cost moving from the 14th to the 17th cake is 30 Rand. Okay, and these are the calculations they would want you to show. So that's quite straightforward. Okay, so the marginal cost is 30 Rand. The next part of the question then says, what is the average variable cost when the firm produces 17 cakes? Show all calculations. So this is where the total fixed cost we worked out earlier is going to come in handy, because an average variable cost is a total variable cost over quantity. In the table, we have total cost. Okay, so what we need to know is that total variable cost is the same as total cost minus total fixed cost. So I can write total variable cost as total cost minus total fixed cost. And that means that average variable cost will be 380 minus 10, which is the total fixed cost, divided by 17. So that's going to give you 370 divided by 17. And if you put that into your calculator, you get an answer of 21 Rand and 76 cents. So a lot of people might have thought, how am I possibly going to work this out with all this missing AVC information? So the important thing is being able to link all the total costs to each other, all the variable costs to each other, and the marginal cost to total cost. So you can summarize all the total costs as follows. Total cost is TFC plus TVC. Total fixed cost would be total cost minus total variable cost. Total variable cost would be total cost minus total fixed cost. Average fixed cost is going to be total fixed cost over quantity. Average variable cost is going to be total variable cost over quantity. Total cost is going to be average total cost over quantity, which you can also write as average fixed cost plus average variable cost over quantity. And then obviously you can rearrange those formulas as well. So you could have, this should be ATC, and this should be TFC, and that should be TVC, So ATC is TC over Q, and total cost is the same as total fixed cost plus total variable cost. Other times we can give you a total cost, and then you need to know that a total cost is an average times a quantity. So you can have total cost is ATC times Q, total fixed cost is AFC times Q, total variable cost is AVC times Q. So ultimately, all of these equations are linked to each other. And understandably, it looks like a lot to learn, but if you understand how a total relates to an average, you simply just need to remember one picture. And this is a picture that a student showed to me, I think it was about 4 years ago, and I've never forgotten it. So those of you who've done physics might have seen silly dumb triangle. A total cost is an average cost times output. So total fixed cost is average fixed cost times quantity. Average fixed cost is total fixed cost divided by quantity. Quantity is total fixed cost divided by average fixed cost. So this one picture, TAC, summarizes all the cost functions and the way that they can be utilized together. So for me, that was a really neat thing that my student showed me 4 years ago. The last part of the question then says, is this firm producing in the short run or the long run? Explain. So if we go right back to the beginning, I told you that the short run is a time period in which at least one of your inputs is fixed, and the long run is a time period in which all inputs are variable. What that means is that in the short run, because there is an input is fixed, there are fixed costs. So whenever there are fixed costs, you're dealing with the short run. If all costs are variable, you're dealing with the long run. So this is the short run because there are fixed costs. Okay. So the first part of the question says, identify curves A, B, C, and D. So these are all your average and your marginal cost curve. So the marginal cost curve is the easiest one to identify. I don't think my friend I can do it is here today, but the way I remember this marginal cost curve is I think of Nike Just Do It. So it's got this tail at the end, which shows decreasing marginal cost because that's where your labor is marginally more productive, and then it increases as labor becomes marginally less productive. So that's the easy one to identify. D is your average fixed cost. And the reason why your average fixed cost is shaped like this, it's always decreasing, is because your fixed cost is a fixed amount. So when you calculate your average fixed cost, you're taking the same value and dividing it by quantity. So when you're dividing a value by a small quantity, 500, you're going to get a very large number. But when you divide that same fixed cost by a larger quantity, you're going to get a smaller number. So average fixed cost is always decreasing because you're spreading a fixed amount over a larger and larger output. So D is AFC. So the only two that are left are average total cost and average variable cost. And average total cost has to lie above average variable cost. And that's because your average total cost is your average variable cost plus your average fixed cost. So it can't possibly be that your average variable cost lies above your average total cost, because average variable cost is part of average total cost. So A is MC, B is ATC, C is AVC, and D is AFC. Okay. 4.2 then asks, why does the distance between B and C get smaller? So B is ATC and C is AVC. And if I look at this formula and AVC, I see the only difference between these two values is fixed cost. So the difference between ATC and AVC is average fixed cost. So why would the difference between these two lines be getting smaller as output goes up? Well, it's because average fixed cost gets smaller as output goes up. So the reason why the distance between B and C gets smaller is because the distance is average fixed cost, and average fixed cost gets smaller as output increases. Okay. Question 4.3 then says, up to which level of output will Barney's Bagel Bakery experience increasing marginal returns? So increasing marginal returns means your marginal product is going up. And if your marginal product is going up, your marginal cost is going down. So marginal returns that are increasing will be over the same range where marginal cost is decreasing. So the outputs up to which marginal returns will be increasing will be up to an output of 500. And the reason why I say 500 is because the measure on the x-axis says that we're measuring in hundreds of bagels per day. So the answer is 500. 4.4 then says, at which level of output does the marginal product of labor equal the average product of labor? Okay, so earlier I showed you that when marginal product is going up, then marginal cost goes down. And when marginal product goes down, marginal cost goes up. So these two curves are related in this way. Okay. We then have average product, which looks like an upside down U. It crosses marginal product at its maximum. So average product looks like this, and marginal product cuts it at its max. Okay, so that's what's being described in this question. At which level of output does marginal product equal average product? And that occurs when average product is at a maximum. average products will be at a maximum when average variable cost is at a minimum. Okay, so average product is maxed when average variable cost is at a min. And the reason why, sorry, that is so messy. The reason why average variable cost is linked to average product goes back to the fact that the only way that you can produce more output in the short run is by employing more people. So you can spend fixed cost and get no output. The only time you're going to get more output is if you spend on labor, and that's going to be your variable cost. So your average product and your average variable cost are linked. So the answer to question 4.4 is going to be 2,000, because average variable cost is at a minimum at 20 times 100, which is 2,000. So the answer to question 4.4 is a quantity of 2,000. When average product goes up, average variable cost goes down. When average product goes down, average variable cost goes up. So to answer Caitlin's question, why are the average curves U-shaped? So the reason why these curves are U-shaped is because of the relationship between marginal and average values. When marginal cost is below average variable cost, or even average total cost, it pulls the average down. So as long as marginal cost is below average, average falls. If marginal exceeds average, then it pulls the average up, so average starts to increase. And that is why the marginal cost cuts average variable cost at its minimum point. The same relationship holds for average total cost. If marginal cost, so curve A, is below curve B, then the average total cost will be pulled down. If the marginal cost is above average total cost, then it pulls the average total cost up. And that's why marginal cost cuts average total cost at its minimum. And the way to think of this is just sort of everyday statistics. If we know of a rugby team that scores a particular number of points per game, so that's an average, we say this team scores on average 20 points a game. Now they play one extra game, the marginal game, and that game goes terribly. They only score 5 points. Because their marginal game is lower than their average performance, it pulls their average down. If their marginal rugby game had been amazing, and let's say they scored 50 points, now their marginal game, the result is greater than their average, and that will pull their average up. So the average curves are U-shaped because of their relationship to the marginal curves. Marginal product equals average product when average product is at a maximum. Okay? And then we know from the picture on the right that average product is a max when average variable cost is a minimum. So it stands to reason that the output at which marginal product equals average product is the output when AVC is a minimum. And in the picture, we can see that this is the AVC curve, C. It's a minimum at that point there, and the quantity is 20 times 100, so the answer is 2,000. For 4.3, we can also use these pictures. The question asks, up to which level of output will Barney's Bagel Bakery experience increasing marginal returns in production? So marginal product, which is the same as marginal returns in production, marginal product is increasing when marginal cost is decreasing. Okay, so in this picture we have up here, there's no product curves, but the product curves are given to us by the cost curves, because product and cost are two sides of the same coin. So if marginal product increases when marginal cost decreases, that means that marginal product will increase up to the point where marginal cost is at a minimum. And that's going to be at 500 bagels. If I took this picture on the right and I flipped it upside down, you would have the picture on the left. They are simply the mirrors of each other. Whatever happens to output in terms of change, the opposite happens to cost. If average product goes up, average variable cost goes down. If average product goes down, average variable cost goes up. And the same for the marginal values. Okay, so the last question here uses some mathematical functions. So they give you a total fixed cost and an average variable cost. And then they ask you to find the marginal cost for Melt's marshmallows of producing the 16th kilogram of marshmallows. Show all calculations. Okay, so we know that to get marginal cost, we're going to have to find a total cost function, because marginal cost is the first derivative of total cost. I also know that total cost is total fixed cost plus total variable cost. I have total fixed cost, which is 300, but I don't have a total variable cost. I have an average variable cost. So what I need to remember is that total variable cost is average variable cost times quantity. So I can take this formula here, multiply it through by Q, and that will give me total variable cost. So total variable cost would be 500Q minus 16Q squared. So I'm going to represent a squared with a little hat, plus 2Q cubed. Okay, so total cost is 300 plus 500Q minus 16Q squared plus 2Q cubed. So in order to get marginal cost, I have to take the first derivative of that function there. So the first derivative of 300 is 0. The first derivative of 500Q is 500. First derivative of 16Q squared is 32Q. And the first derivative of 2Q cubed is 6Q squared. So that's my marginal cost function. But now the question is asking me to specifically calculate the marginal cost of the 16th kilogram of marshmallows, which is what Q represents. So the marginal cost when Q equals 16 is going to be 500 minus 32 times 16. So all I'm going to do is sub in 16 for wherever I see Q, plus 16 squared. So that's going to give me 500 minus 32 times 16, which is 512, plus 6 times 16 squared. So 16 squared equals 256 times 6 is going to give me 1536. So the answer is going to be the difference between these market structures comes down purely to market power. Okay, so with perfect competition, you have no market power. Every firm is a price taker. They have to charge the price that is set in the market. But if you're a monopoly or monopolistically competitive firm, you have some price setting ability because you have some, or in the case of monopoly, substantial market power. So the difference between these two markets, or three markets to be more correct, simply comes down to the demand and marginal revenue curves. At the basis, they have the same cost curves. All firms have a marginal cost curve that looks like a Nike tick. All firms have average cost curves that are U-shaped. The real difference comes down to demand and marginal revenue, because that reflects the market power that that firm holds specifically with regards to whether or not it can charge a price that is not set by the market, but rather set by consumers. Because monopolies and monopolistically competitive firms, they will charge the maximum price that they perceive their consumers are willing to pay. Okay, so that's ultimately the big difference. The first question that I've chosen is one that, in terms of when I've seen people practice this particular past paper, they seem to all get this question wrong. And this comes down to careful reading. So this question says, a firm's main objective is to maximize total revenue. A firm's main objective is to maximize total, well, actually not even total, is to maximize economic profits. So this answer is false, because maximizing your total revenue does not guarantee maximizing economic profit. Maximizing total revenue just means you're able to make the largest revenue you're possibly able to make. And getting to maximum total revenue might actually rely on having a very large total cost. So if you get to maximum total revenue, you might actually be making very little economic profit, because to do so, you've had to produce a lot, and to produce a lot means having to incur a lot of cost. So a firm's main objective is not to maximize its total revenue, it's to maximize its economic profit. So the answer to this question is false. How does a firm decide on an output that maximizes its profit? So I'm sure most of you who have been studying are eating, sleeping, breathing MR equals MC. So MR equals MC is the condition for profit maximization. If you produce where MR equals MC, you will profit maximize. The reason why this is the case is because of a little picture they have in your textbook. So I'm going to draw it quite roughly here. So they give you this picture, and you have a total revenue curve that does not look like that. You have a total revenue curve that is a straight line, like that. Your total cost curve has a positive intercept because there will be a total fixed cost. So your total cost is not going to come out of the origin. It's going to have a positive intercept because that's the total fixed cost of producing. Initially, when your labor is productive, your total cost increases at a decreasing rate. But then at some point, your labor becomes less productive and your total cost increases at an increasing rate. So that's your total cost curve. Okay, so you've got your total revenue curve and your total cost curve. What we can see from this picture is that anywhere between these two lines is a loss because total cost exceeds total revenue. So any quantity up to that point there, the firm is making economic loss. At exactly this quantity here, the firm is going to make normal profit because total revenue equals total cost. So that's a normal profit position. It's then also the case that the firm is going to make normal profit at this point here, because at that point there, again, total revenue equals total cost. So these two quantities here, quantity 1 and quantity 2, represent zero economic profit. Anything below quantity 1 is economic loss. Anything above quantity 2 is economic loss. So it's in between quantity 1 and quantity 2 where the firm makes economic profit. And the point at which the distance between these two lines is going to be the largest is when the slope of this total cost curve and the slope of this total revenue curve are the same. So when those two curves, so in this case a line for total revenue and the total cost curve, when they have the same slope, the distance between them is its largest. So that is where profit is going to be maximized. And the slope of your total revenue curve is marginal revenue, and the slope of your total cost curve is marginal cost. So profit is maximized when marginal revenue equals marginal cost. So in terms of this question, a firm's profit maximizing output in a perfectly competitive market is necessarily where the gradient of total revenue is 0. If the gradient of total revenue is 0, that means that marginal revenue is 0. Okay? So total revenue is 0 when there's absolutely no marginal revenue being made, and in perfect competition, because price is marginal revenue, that would mean you have a price of 0. And that can't possibly be true. It can't possibly be the case that you are producing where price is 0. Okay, so A is incorrect. The firm's profit maximizing output is necessarily where total cost is minimized, for the same reason that maximizing economic profit doesn't occur where total revenue is maximized. Maximizing profit is also not going to be where total cost is minimized. If you're minimizing total cost, basically in order to minimize total cost, you have to be producing nothing, because the minimum value that total cost can take is total fixed cost. So if profit is maximized where total cost is minimized, that's arguing that profit is maximized when nothing is produced, which can't possibly be true. 2C then says the gradient of TC is equal to the gradient of TR. So in other words, C is saying the gradient of total cost, which is marginal cost, is equal to the gradient of total revenue, which is marginal revenue. And that is true. So the answer C is correct. And for the same reason that B is incorrect, D is incorrect. So the answer to question 2 is C. Okay. So question 3 then combines this knowledge with a little example. What this example is illustrating is just the primary logic behind profit maximization. And it doesn't use a graph, it uses a little bit of a word problem. But essentially, this information that is given here could be replicated in a graph. What we need to understand about pretty much everything that is presented in Economics 114 is that in order to achieve the best outcome, so best outcomes come from rational decision making. And that goes all the way back to chapter 1. So rational decision making means that you are comparing the marginal benefits of doing something to the marginal cost, and you would continue to produce, consume, work, whatever the activity you're doing is, you would continue to do it as long as the marginal benefit is greater or equal to marginal cost. The minute marginal cost exceeds marginal benefit, it is irrational to have done that activity. So the minute it costs you more to work than the benefit you get from working, it was irrational to work that extra amount. You should cut the amount you work. Same with production. If there comes to a point where by producing an extra unit, that unit cost you more than the benefits it brought you, and with regards to production, the benefit that units that are produced bring is revenue, then you shouldn't have produced it. So the comparison of marginal revenue to marginal cost is simply rational decision making at the level of the firm. So when we look at this question, it tells us that Paul sells printers in a perfectly competitive market for 300 Rand each. What that means is that Mark can only charge 300 Rand. So his marginal revenue is always 300 Rand. In terms of the picture of a perfectly competitive firm, what this tells us is that his price is given to him at 300 Rand, and this is where his demand and marginal revenue curve lies. Okay, so that's his marginal revenue and demand curve. The marginal cost of the first printer is 200 Rand. The marginal cost of the second printer is 250. And the marginal cost of the third printer is 350. So to maximize his daily profit, Paul should sell how many printers? So we apply rational decision making to this problem. If the first printer costs 200 Rand, but it gives him a marginal revenue of 300, should he produce it? Yes, because MR exceeds MC. The second printer costs him 250 Rand to produce, and he can sell it for 300 Rand. So should he produce the second printer? Yes. The marginal revenue of 300 exceeds the marginal cost of 250. When it comes to the third printer, should he produce it? No, because the marginal cost of 350 now exceeds the marginal revenue of 300. So in other words, the third printer is going to be marginally loss-making for him, and because that printer makes a marginal loss, it's going to take away some profit. So to maximize his daily profit, he should produce 2 printers a day. Even though that second printer isn't exactly where MR equals MC, as long as MR is at least greater than or equal to MC, you continue to produce. But the minute MC becomes greater than MR, you should not have produced that unit. And that's why the answer is B. Profit would be maximized when its derivative is 0. Okay, so that we know. A function reaches its max or min when its derivative is 0. So the first derivative of profit, I'm going to get by using this function. Profit is equal to total revenue minus total cost. Okay, that's how we calculate profit. The first derivative of total revenue is marginal revenue. The first derivative of total cost is marginal cost. And if I want to find where this, the first derivative of the profit function, is at the max, I set it equal to 0. And if I rearrange that formula, I get the first derivative of profit is 0 when marginal revenue equals marginal cost. So that's a short little mathematical proof for why MR equals MC is the profit maximizing point for outputs. So it tells us that MC is equal to ABC at 20 Rand, MC is equal to ATC at 30 Rand, and MC is equal to average revenue at 25 Rand. So I'm going to put this information into a picture. So we have an MC curve, and that's the general form of it. We have an AVC curve, and remember the AVC is at a minimum when MC cuts it. So this is minimum AVC. And then we have ATC, whose minimum also goes through the MC curve. So these are my 3 cost curves under consideration. So when MC is equal to AVC, that happens at AVC's minimum. So what I can say is that this point here happens at 20 Rand. MC is equal to ATC when ATC is at a minimum. So I can say that this value over here is 30. Okay, so that's that information. The third condition then says MC equals average revenue at 25. So the trick here is knowing that average revenue is the same as price. And the reason I can say that is because total revenue is price times quantity. Average revenue is total revenue divided by quantity. So if I take that function, price times quantity, and divide it by quantity, I just end up with price. So average revenue is the same as price. So because this is a perfectly competitive firm, that tells me that the firm is currently charging a price of 25 Rand. So 25 is where the marginal revenue is equal to demand. That's the price that has been given to the firm by the market. So that's this information summarized in a picture. The first question says, how will the firm determine its profit maximizing level of output? So the way that firms determine what output maximizes its profit is it finds where MR equals MC and produces the output at that point. Okay, so MR equals MC defines the profit maximizing level of output. What price will this firm charge? So this is a perfectly competitive firm, which means it has no influence over price. It is a price taker. So whatever the price is that the market has set for it, that's the price it will charge. So this firm will charge 25 Rand. Should the firm produce in the short run, why or why not? So this comes down to the decision of shutting down or not. So all firms have two short-run decisions to make. The first decision is, do I produce? The second decision is, how much do I produce? So the second decision is MR equals MC. The first decision is about shutdown. So the first decision is basically you saying, well, does it make sense to stay open? Will I have enough business to cover the cost of being open? So the cost of being open and producing is the variable cost, the fixed cost you have to pay irrespective. So the decision about do I produce is about how does price compare to ABC. As long as your price is greater than or equal to ABC, then it makes sense for you to stay open because at least you can cover the cost of being open, the variable cost. If your price was exactly equal to ABC, you could decide to shut down because whether you stay open or shut down, you make the same loss. You make a loss of fixed cost. If your price is less than ABC, you would shut down because then you're not able to cover the cost of staying open. Okay, so if we look at this picture, we see price of 25 is above the shutdown point at minimum AVC. So minimum AVC is what we call the shutdown point. If you are at a price at this level here, then you have to make a decision, do I shut down? So that's the shutdown point. Okay. So the fact that the shutdown point 20 Rand is less than the current price of 25 Rand means yes, you should produce. So yes, because price is greater than ABC. So it makes sense to stay open. The next question then asks, will the firm earn a profit or incur a loss? Why? So even though it makes sense for me to stay open, because I'm covering my costs of operating, my variable costs, I still make a loss. So ATC of 30 currently exceeds the price of 25. So what I can see from this information is that it will be a loss, and the reason why is because price is less than ATC. Okay. So the important thing to take note here is that the decision to produce can result in a loss, but that loss is being minimized. The loss you're choosing to make is smaller than the loss you would make had you chosen to shut down. And that is why this firm will produce even though it is making a loss. So the next question actually speaks to this theory as well. It says, do you think it can ever be sensible for a firm in a perfectly competitive market to produce when price is below average total cost? Explain your answer. So what we saw in the question above is, yes, it can make sense, because even though price is less than ATC, it could be greater than AVC. So yes, it can be sensible to produce when price is less than ATC, because as long as price is greater than AVC, the firm can cover its costs of operating and therefore will be minimizing its economic loss. If it had shut down, its economic loss would have been greater. So it can make perfect sense for firms to operate with losses, because that loss that they are operating with is smaller than if they had chosen to not produce at all. So question 6 talks about the short run. So essentially, there are short run decisions and there are long run decisions. Short run decisions are these two. Do I produce, which is the decision to shut down or not? And if I produce, how much? So the short run has to do with whether you produce or not. Long run decisions have to do with entry and exit, as well as the adjustment of the size of their plants, because B refers to a fixed input. In the short run, you cannot adjust your capital. You could only adjust your labor. So A refers to a long run decision because it has to do with entry or exit. B is a long run decision because you can only alter your capital over the long run. In the short run, firms can earn an economic profit because in the short run, there are 3 potential outcomes. And this is true for any firm, not just perfectly competitive firms. In the short run, all firms can make economic profits, an economic loss, or normal profits. Okay, so this is the same as positive economic profits, this is the same as negative economic profits, and this is the same as zero economic profits. So those short-run outcomes are relevant for all firms: monopolies, perfect competition, monopolistic competition. So the answer C is definitely a short-run possibility. D, firms can charge a price above the market price. That isn't true because in perfect competition, firms are price takers. So firms take the market price as a given. So question 7 then shows perfect competition in a graph, and it says in the figure below, if the price is P1, the firm will produce how much? So firms will produce where MR equals MC. So that's the profit maximizing condition. Produce where MR, and remember in perfect competition, wherever the market price is, that's the firm's MR and the firm's demand curve. So the firm is going to produce Q2. Okay, so definitely A is wrong. It's not the case that the firm is going to produce nothing. B then says the firm is going to produce where MC equals ATC. So if we look at this picture, where MC equals MR, it is actually above ATC. If MC was equal to ATC, it would have to be the case that ATC was then sitting on top of the demand curve and touching at that point there. But ATC lies below the demand curve. So B is incorrect. C says where MC equals price 1. Yes, that's true, because price 1 is the same as marginal revenue for a perfectly competitive firm. And then D says where ATC equals price 1. So that's over there. And we can see that that point there does not satisfy profit maximization. So D would be incorrect. So the answer is C, where MC equals price 1. So the important theory for this question is knowing that under perfect competition, marginal revenue of firms equals the demand for the product and is also equal to the market price. Okay. This shows a similar picture, except now we don't have the price. All we have is MC, ATC, and ABC. So this question says the figure below shows the cost curves of a firm in a perfectly competitive market. The price per unit is currently 7 Rand. So because this is perfectly competitive, it means the firm has to charge this price of 7 Rand because it's a price taker. So we're going to have the demand curve at 7 Rand. So this is going to be the demand equals marginal revenue curve. So question 8.1 asks, how much will the firm produce? So again, just like every other example, we're going to produce where? MR equals MC. So the firm is going to produce 40 units per day. So the answer to question 8.1 is 40 units. Okay. Question 8.2 then says, what is the firm's economic profit at this price? So economic profit, we calculate, so I'm actually going to type that out. Economic profit, we calculate as price minus ATC times Q. So what we need from this picture is we need price, which we know is 7 Rand, because that's given to us. It's the market price. We need to find out what ATC is, and we know that quantity is 40. So to find ATC at the quantity of 40, we go to this 40 and we read up to the ATC curve. And this value here is the ATC for 40 units. So I can see that the ATC at 40 units is 4 Rand. So the answer is 120 Rand. 3 Rand times 40. What will happen in this market in the long run? So in the long run, firms have two decisions. The first decision, they could either enter or exit. And the second thing that they could do in the long run is they can change their plant size. So basically increase their capital. Now, when it comes to the dynamics of perfect competition, we've only covered entry and exit. So you can kind of ignore that as an option. So what we want from you here is a discussion of whether or not this short run outcome will create either entry or exit into this market. So first, just to argue why this is a short run, this graph, and you wouldn't need to include this as an answer, I'm just giving you this extra information. This graph shows a short run for 2 reasons. Because sometimes we follow up with questions like, how do you know if this firm is in the short run or not? So there are 2 reasons why we can see this firm is in the short run. The first reason is it is making positive economic profit. And positive economic profit is only possible in the short run. Secondly, there are fixed costs. How do I know there are fixed costs? Because ATC and ABC are different. So the fact that ATC and ABC are different implies that they're a fixed cost, which implies that this is the short run. Okay, so we're dealing with a short run scenario here. And this short run scenario is going to change the market in the long run. And it's going to change the market in the following way. If firms are making positive economic profits, new firms will enter the market. This will increase the supply. This will increase the market supply, which will cause market price to fall. So firms' profits will fall. In the short run, you are deciding whether to produce or not. Okay, so that's the decision to shut down or not to shut down. So shut down doesn't mean you exit. Shut down means you just decide to stop producing temporarily. So a really easy example of this is, if you think about most businesses are not open 7 days a week. Some businesses are, especially businesses in shopping malls. And the reason why businesses in shopping malls are open all the time is because it makes economic sense to be open all the time, because there's always foot traffic. When everybody's off on the weekend, they go to the mall. So it makes sense that businesses in the mall would be open on Saturdays and Sundays. But if you're somebody who runs a small shop in your town, if everyone in your town is choosing to go do something exciting, go somewhere else on a Saturday or Sunday, it doesn't make any sense for you to stay open, because you're not really going to make enough money to cover the cost of being open. So in the short run, you're deciding whether to produce or not. So you're having to compare your price to ABC. You want to know, is the price I can get going to at least cover my cost of producing? In the long run, you are deciding whether to enter or exit a market. And that has to do with whether or not price is greater than ATC. In that case, firms would enter, or whether price is less than ATC. In that case, firms would exit. This is the difference between the short run and the long run. In the short run, do I produce or not? In the long run, do I enter this market or do I exit completely? So in terms of this question, what will happen in this market in the long run? Because firms are making positive economic profits, this will encourage new firms to enter. If new firms enter, supply will go up. And then what we know from chapter 3 all the way back in the day is that if supply goes up, so if supply shifts to the right, price goes down. Okay, so we can see that a higher supply of sellers in this market will cause the market price to fall. And if the market price falls, and because there are now more sellers in this market, the quantity sold by the market goes up. How this affects individual firms is, if the price you're able to charge goes down, that means your marginal revenue curve is going to drop. And as your marginal revenue curve drops, it means you're going to move down along your marginal cost curve, and you're going to start making less and less profit. And eventually, at some point, your marginal revenue curve is going to have shifted all the way down to the point where you're making normal profit. So where you're at your minimum ATC. So that's how the dynamics work when firms make positive economic profit. If the opposite was true, if firms are making negative economic profit, firms will exit the market. And if firms exit the market, this will decrease the market supply, which will cause market price to rise and market quantity will fall. And if market prices are rising because firms are exiting, If you so happen to be one of the firms that stay in the market, then your price will rise, and that means your economic loss will get smaller. So in the case of market exit, we're going to have the opposite impact on firms. With market exit, we're going to have firms' profits will rise. In other words, their losses will fall. And exit will continue until all firms are making zero economic or normal profits. So those are the dynamics of market exit and entry. And what it means is that in the long run, perfectly competitive firms can only make normal profits. The minute any positive or negative profits are made, so I'm going to be very particular there, economic profits are made, this will encourage long-run exit and entry. So the whole point of a perfectly competitive market is because there's complete freedom of entry and exit. There are no barriers to firms setting up or leaving this market. It means that in the long run, everyone is limited to normal profits, because any positive profit would encourage entry, which would take profit away from you. Any loss would cause some firms to leave, and that would then mean you now gain profit, so you move up. So eventually, in the long run, all firms will make normal profits. Okay, so question 9 now talks about imperfectly competitive markets. So what we mean by imperfect is the opposite of perfect. So an imperfectly competitive market is a monopoly, an oligopoly, or monopolistic competition. Essentially, all other market structures are imperfectly competitive. Okay, so a firm in an imperfectly competitive market is currently producing a quantity of 15,400 units. At this quantity, price equals 45 Rand, MR equals 35 Rand 60, MC equals 35 Rand 60. So what we can see from this information is that marginal revenue equals marginal cost. So that this firm is maximizing profits. If the firm were to increase its production by 1 unit, price would decrease, marginal revenue would decrease, total revenue would increase, marginal cost would increase, and economic profit would decrease. So this is like juggling a million balls at once. I mean, basically, we're asking you, is this statement true or false? But we're asking you to prove that 1, 2, 3, 4, 5, 6 individual statements are correct. Now, it just so happens that everything that is described in the statement can be drawn in a graph. So imperfect competition means that you have price setting ability. And if you have price setting ability, you face a downward sloping demand curve. Then, if your demand curve is downward sloping, it means you have a downward sloping marginal revenue curve. So this is going to be your marginal revenue curve. They both have the same intercept, and the marginal revenue is twice as steep as the demand curve. I'll show you a proof for that later on when we do this question down here. So we have this marginal revenue and this demand curve, and then all firms have marginal cost curves that look like this. So what we know from the information above is that MR equals MC. So the firm is producing the quantity that maximizes profit, and MR equals MC at 35 Rand 60. So this value here is 35 Rand 60. Okay. Then they tell us that the price they charge is 45. So we know that imperfectly competitive firms are able to set price at the maximum price that their consumers are willing to pay. So they find their profit maximizing position here. This gives them their quantity, but then they end up charging the maximum price that consumers are willing to pay, which is given by the demand curve. So that's 45 Rand. So the question then says, what happens if we just increased the amount we produce by just 1 unit? So if you move quantity even just a little bit to the right of this equilibrium, what that means is that you are going to increase your marginal cost. So if output goes up, marginal cost goes up. It always costs more to produce additional units. If quantity goes up and you face a downward sloping demand curve, the only way you can sell more is if you charge less. And if you charge less, you're making less marginal revenue. So if quantity goes up, price decreases, and marginal revenue decreases. Okay, so that we can just see from looking at the graph. So in the answer here, if the firm were to increase its production by 1 unit, yes, price would decrease, yes, marginal revenue would decrease, and yes, marginal cost would increase. The other two statements are, would total revenue increase and would economic profit decrease? So if MR equals MC is where profit is maximized, if you move away from your profit maximizing point, it means you're going to lose economic profit. So if you move beyond the point where MR equals MC, that means economic profit will fall, because you're moving away from the profit maximizing point. So it makes sense that you're now reducing your profits. So the statement economic profit would decrease is also true. So the last one, would TR increase? This is the trickiest one of the lot. So what we know about total revenue is that total revenue is related to the demand curve, and total revenue is also related to elasticity. So what we know from chapter 4, and it's repeated in chapter 12, is that total revenue increases when price decreases if elasticity of demand is greater than 1, so when it's elastic. Total revenue decreases when price decreases if elasticity of demand is inelastic, so less than 1. What we know about monopoly demand curves and also monopolistically competitive demand curves is that they always produce and charge prices along the top half of their demand curve. So in other words, monopolies and monopolistically competitive firms always produce on the elastic part of their demand curve. So always produce and charge a price on the elastic part of their demand curve. So if they're always on the elastic part of their demand curve, it must mean that if price decreases, total revenue increases. So the statement here, total revenue would increase, is correct as well. So the answer to this question is true. This question tells us a monopoly's total cost and marginal revenue are given by the following functions. Derive the firm's profit maximizing output. So what we need to then find is where MR is equal to MC. So firms will profit maximize when MR equals MC. We have MR, it's 1000 minus 2 over 5Q. We have to find MC, and MC would be the first derivative of total cost. So the first derivative of that function there would be 800 falls away, 12Q becomes 12, and 1 over 5q squared becomes 2 over 5q. So this is MR equal to MC. And then we just solve for Q. So if I take all the Q's to one side and the units to the other side, I get 988 is equal to 4 over 5Q. And then if I multiply 988 by 5 and divide it by 4 times 5 divided by 4, I get 1235 equals Q. So the profit maximizing output is 1,235. The next part of the question then asks, what price will the monopolist charge? So if I go back to this graph here, what I told you is that once we find MR equals MC, so we find this quantity, the monopoly will then charge the maximum price it can get for that quantity. So it will charge a price according to its demand curve. In this question, we don't have the demand curve, but we can get it from the marginal revenue function. And the way that works is, if demand is generically given by this, price equals A minus BQ, and we know that total revenue is price times quantity, then I can just substitute in price with A minus BQ times Q. So I'm just replacing this price with this. That will then give me A times Q minus B Q squared. And marginal revenue is the first derivative of this. And if I take the first derivative of this equation here, I get A minus 2BQ. So if you compare this function for the demand curve with this function for marginal revenue, what you'll notice is that the intercept is the same, and the marginal revenue has twice the slope of demand. Okay, so if I give you a marginal revenue function, I actually at the same time as I'm giving you the demand curve. So in this case, price will be 1,000, the same intercept as marginal revenue, minus, and this is where you have to be careful, because marginal revenue has twice the slope as demand, it means demand has half the slope of marginal revenue. So whereas the marginal revenue here has minus 2 over 5 as the slope, demand will be minus 1 over 5 times Q. So it's half the slope. So price will be 1,000 minus 1 over 5 times that quantity 1235. So the price will be equal to 1235 divided by 5 is 247. And if we take that away from 1,000, we get an answer of 753. So the price that would be charged at this profit maximizing output is 753. So that's the answer to 10.2. 10.3 then asks us, what is the markup on the last unit produced? So I'm just going to show you in the picture where we find the markup. The markup is the additional revenue that is made on the last unit produced above its marginal cost. So markup is this distance here. It's price minus marginal cost. Okay, so if we know what the price is at the quantity and we know what the marginal cost is at the quantity, then we can find the markup by that difference. So in this example, what we need to do is we need to then put that quantity 1235 into the marginal cost function, which is 12 plus 2 over 5q. So the marginal cost is going to be 12 plus 2 over 5 times 1235. And that's going to give me a value of plus 12 of 259. Let me just double check that. I might have divided by 5 and not times by 2. Yeah, times 2 plus 12. So this is 506. Okay, so MC is 506 at a quantity of 1235. So that means that the markup is going to be 753 minus 506. So it's going to be 247. Okay, so then this is referring to excess capacity. So I'm going to show you excess capacity in this picture. So excess capacity has to do with monopolistically competitive firms who produce below what is economically efficient. So monopolistically competitive firms, because they exist in competitive markets, even though they're monopolistic in that they're able to differentiate their product, they're able to create a product that is unique, different from the competition. I mean, it's like comparing Country Road jeans to Mr. Price jeans to Levi jeans. These are all very different products, but they all fall under the market of jeans. And everyone can charge a price according to the relative demand for their product. So whether or not people perceive their product as high quality or well branded or, something that is super desirable. The point is that because it's competitive, not perfectly competitive, but competitive, it means any time these firms make above normal profit, this will encourage new entrants into the market. So when firms in the jean market, all of them supplying very diverse types of jeans, if they're doing really well, if we look at the statistics and see that jeans are selling really well, then firms are going to move in because they're going to want to take part in this highly profitable market. So in monopolistically competitive markets, in the long run, these firms can only make normal profits. So for monopolistically competitive firms in the long run, the ATC curve is just tangent to the demand curve at that profit maximizing point. And that means that they make zero economic profit. If they were economically efficient, so economic efficiency, going back to earlier, means you produce at lowest cost. If they were economically efficient, they would actually produce this quantity here. So this would be the economically efficient output. But because they want to profit maximize, they produce here in order to charge that price. So the difference between what they produce and what they could produce if they were efficient, that is excess capacity. So excess capacity is the output that could be produced in order to bring the firm to minimum cost of production. And that is why the answer to question 11 is false, because excess capacity is not unsold output. It's output that was never produced. It's output that could have been produced in order to bring cost of production down, but it wasn't produced because in doing so, the firm would have not maximized profit. The next question is about price regulation for a monopoly. So the reason why monopolies have to be regulated is because monopolies charge more than perfectly competitive markets and they produce less. So if we look at a monopoly market, it has a downward sloping demand. It has supply, which is the same as marginal private cost, the cost of the firm. It then has a downward sloping marginal revenue curve, which has the same intercept as demand, but twice the slope. And this firm is going to produce here, where MR equals MC. So a monopoly would produce this quantity. So this would be the monopoly quantity. But the monopoly, as a price setter, would charge the maximum price consumers are willing to pay for that quantity. So this would be the monopoly price. If this market was perfectly competitive, then we would be where demand equals supply, because that's where perfect competition ends up. And that means under perfect competition, quantity would be greater than monopoly, and price would be lower. So monopolies charge higher prices, they produce lower quantities, and because of this, they generate deadweight losses. So if government price regulates a monopoly, what it does is it says to the monopoly, you may not charge this high price, you have to charge the perfectly competitive price. So it will regulate it through making it illegal for the monopoly to charge its high monopoly price. So the result of that regulation is price would go down, quantity would go up, and the deadweight loss would disappear because it would then put the market into equilibrium. So the answer to this question is true. Price regulation means monopoly prices go down, their quantities go up, and we reduce the deadweight losses that they generate. So chapter 18 has to do with the firm's choice of labor. And the whole point of chapter 18 is actually very similar to chapter 11 and 12. So the whole point of the market structure stuff was to say firms will produce where MR equals MC because that is where profit is maximized. Okay. In chapter 11, we argue that if you want to increase outputs, you have to employ labor. Okay. What that means is that the decision to produce a profit maximizing output is the same as the decision to employ the amount of labor that produces that profit maximizing output. So in other words, when we find MR equals MC, we are also finding VMP, so that's the value of marginal product of labor, equal to wage. So that marginal decision-making process of whether or not to produce an extra unit, that is you as a firm comparing marginal revenue to marginal cost. You decide, am I going to produce another unit? You think, well, is its marginal revenue going to exceed its marginal cost? If so, yes, I produce it. If the marginal cost exceeded the marginal revenue, no, I shouldn't produce it because then I'm losing profits. The same applies to labor. When you make the decision to employ somebody, that person brings potential value to the firm in the form of revenue. So when you employ a person, that person makes a marginal product. That is the additional output that that person produces for you. You can then take that output and you can sell it in the market. So VMP is the same as marginal product times price. It's the output produced by that one person multiplied by the price that you can then charge for that output. So you will employ somebody as long as the value they bring in the form of revenue is at least equal to or greater than what it costs you to employ them. So this is the marginal benefit of employing a person. This is the marginal cost of employing a person. So if the marginal benefit is greater than the marginal cost, you employ them. If the marginal benefit equals the marginal cost, you employ them. But if the marginal benefit became less than the marginal cost, then you wouldn't employ them because that wouldn't be a rational decision. So this is the whole point of chapter 18, is trying to find how many people should you employ, and you will solve for where VMP equals wage. So in this first question, we tell you, you are the manager of a firm. The marginal product of labor is MP equals 1000 L minus a half. So that's the marginal products function. Your firm is a competitor in a perfectly competitive computer screen market. The price of a computer screen is 500 Rand. So that's the price you're going to charge. So that is that price there. Further, suppose that the firm is a competitor in the perfectly competitive labor market. The wage rate is 100 Rand. So that's the wage. Given this information, what is the value of the marginal product of labor? So the value of marginal products of labor is marginal product times price. So the marginal product function they've already given you, they've told you it's 1000 L minus a half. Now we simply multiply that by the price, which is 500. Okay, so not 100 because that's the wage. So the VMP will be equal to 500,000 L minus a half times 500 gives me 250. So the answer to this question is A. 500,000 L minus 250. So we get given this question, Jack Hose produces jackets and buys labor in a perfectly competitive labor market. The firm's average product of labor is at its maximum and is equal to 40 jackets. Okay, so that's important information. Average product is currently at its max. That is important information because going all the way back to chapter 11, when is average product a maximum? Average product is a maximum when average product equals marginal product. Okay, so marginal product equals average product when average product is at a maximum. So by giving us this information that average product is a max at 40 jackets, that means marginal product is currently 40 jackets. Okay. The value of marginal product is currently 400 Rand. The market price at which the firm is selling its output is what? So a VMP is equal to marginal product times price, and marginal product is 40, then it must mean that price is 10 Rand. Okay, so the solution to this question relies on you knowing that average product is maximized when average product is equal to marginal product. The answer to this question is B, 10 Rand. Okay, so this is a past paper question from last year, and what we told you is that Akona is the owner of a firm that produces leather jackets. She currently employs 40 people, and she pays them 3,000 Rand per week. Okay, so here we've told you it's per week. The firm currently produces 30 jackets. So 40 people produce 30 jackets per week, and each jacket sells for 1,000 Rand. Akona estimates that if she hires one more person, this person would add 5 jackets to her production. Okay, so that's a super productive person. So this one person is going to add 5 units of jackets. That's their marginal product. Assume there are no variable costs other than labor, and that the labor market and the leather jacket markets are both competitive. So what that last bit of information tells us is that every leather jacket sells for 1,000 Rand, and every person is paid 3,000 Rand. Okay. The first question that asks you, would you advise Akona to hire an additional worker? Explain your answer by referring to the costs and benefits of hiring an additional worker. So what we see from the above is that the marginal product of this extra person is 5 jackets. Okay? Because when she employs this additional person, total product increases from 30 to 35. So their marginal product is 5 jackets. That means their value of marginal product is 5 times 1,000, because that's how much each jacket would be sold for. The cost of employing this person is 3,000 Rand. So does it make sense to employ this person? Yes. Employ the extra person because their value of marginal product exceeds the wage. In other words, the marginal benefit of this person to the firm exceeds the marginal cost of the person to the firm. So yes, employ her. 3.2 then asks, how would a fall in the price of leather jackets affect Acorna's labor demand? Explain your answer briefly. So the demand for labor is the same as the value of marginal product. Firms demand labor according to the value they bring. You can think of that in the same way as any consumer. When a consumer buys a product, they get marginal benefit. That's what gives the demand curve. With a firm, when they hire a person, so they're consuming a person, they're demanding them, then they extract a marginal benefit from employing that person. And that marginal benefit is the value of marginal product. So the demand and value for marginal product are the same. So if the price of jackets falls, this means the value of marginal product will fall, because the value of marginal product is MP times price. So if the value of marginal product is falling, demand for labor will fall. Okay, so because the firm is getting less money per jacket, this means that every unit a person produces is bringing less value to the firm. The benefit of a jacket becomes less because the price of the jacket has gone down. And if the value that an additional worker adds to the firm goes down, the chances that they may not be employed goes up, because now the value they bring in may be less than the wage that they're paid. Okay, so if the price of your product goes down, the demand for labor falls. So this question was given in a past paper as a multiple choice question, and it did create some issues because it does require an understanding of how the backward bending supply curve works. So I'm going to draw it first before we go to the question, just so that you have some good definitions of substitution and income effect before we go to the question. So every single individual who has a choice to work has to choose between working and not working. So you have certain hours available to you in a week, and you will choose to divide those hours between working and not working. Okay. So depending on what someone is offering to pay you, that will determine how much you are willing to work. So we say that no one's willing to work for zero. Okay. Everybody has what we refer to as a reservation wage. That represents the minimum wage that would convince you to go from not working to working. Okay, and that can be any amount. It's going to be different from person to person. For some people it might be 20 Rand an hour, for some people it might be 500 Rand an hour. It really depends on an individual and what their preferences are. So the minute your wage that you're offered goes above your reservation wage, you will start to work more. Okay? But at some point, your wage will get high enough that you will actually work less. So this is what we mean by the backward bending supply curve of individuals. Initially, as your wage goes up, you work more. But at some point, as your wage goes up, funnily, you work less. And the reason why is because there are two effects at play: the substitution effect and the income effect. Don't want to move that. Okay, so the substitution effect says always, so the substitution effect argues that an individual will consume, okay, so I'm using the word consume here because we do consume work and leisure. So an individual will consume more of a good that is relatively cheaper. Okay, so when the cost of something goes up, we will substitute away from that thing towards something else that is now relatively cheaper. So when wages rise, what that means is that the cost of not working, which is leisure, increases. If you choose not to work and rather choose to spend time in leisure, you are giving up a wage, and that is a cost. It's an opportunity cost. So when wages go up, it becomes more expensive not to work, and that means you will choose to work more hours. So that's the substitution effect. The substitution effect says wage increases, and as a result, work increases. Okay. The income effect, on the other hand, says that an individual will consume more of a normal good if their income increases. Okay. Leisure is a normal good. It is something that we will consume more of if we have more money. So the income effect says if wages increase, income increases, so the demand for leisure increases. So the income effect has the opposite effect of substitution. Wage increases, work decreases, because you would rather consume more of this normal good, the leisure. So what this means is that when you are on the upward sloping part of the labor supply curve, so when you're at this part that's upward sloping, that means that the substitution effect dominates the income effect. That's why higher wages, more work. Okay, so in other words, your wage isn't yet high enough for you to have enough income to be able to make that decision to work less. If you are on the backward bending part of your supply curve, okay, so if you're on this part of your supply curve that bends back, then it means your income effect dominates the substitution effect. So in this case, higher wages means less work overall. So the backward bending part of your supply curve is this part here, and that's where your income effect dominates the substitution effect. So if we go back to the question, we're going to use this information now to answer Zorene's choice. So Zorene works as a freelance photographer, taking photographs for fashion magazines. She used to earn 400 Rand per hour, but unfortunately the financial position of the fashion magazine industry has deteriorated, and it has become harder for her to sell her services. So she now only earns 300 Rand per hour. If she responds by working more, so she's earning less per hour, but she's working more, what must this imply? So if we go to the picture, and if this is where 400 Rand was, right? And now her price that she could charge per photograph went down to 300. That is the only way that a lower wage could have caused her to increase the amount she works. So the fact that a lower wage resulted in her working more means that she had to have been on the backward bending part of her supply curve when this price change occurred. So in terms of the answer, what it's saying is that the income effect dominates the substitution effect, because that puts her on the backward bending part of her supply curve. It doesn't mean that she regards leisure time as an inferior good, because in actual fact, the opposite is true. She has less income, so she's consuming less leisure. That tells you that leisure is a normal good. So B can't be right using that logic. Her reservation wage is higher than 300 Rand per hour. That also can't possibly be true, because if her reservation was higher than 300 Rand per hour, she wouldn't be working at 300 Rand an hour. So A has to be wrong. C says, the income effect and the substitution effect in terms of her supply of labor work in the same direction. That can't be true if leisure is a normal good. Because if leisure is a normal good, then if the cost of work is going up, then she consumes more leisure. So C can't be correct, B can't be correct, A can't be correct. D is the only answer that satisfies the result that we see in the question. It's just a very straightforward true and false question. Basically, it asks whether or not game theory is a theoretical framework for studying behavior that takes into account the expected behavior of other decision makers. So the answer to this is true. Fundamentally, game theory allows us to observe behavior that is interdependent. So interdependence means that the actions of one player in the game directly impacts the outcome of the game for other players and vice versa. So game theory tells us that when you need to make a decision, you can't just make that decision in isolation from others' decisions, because others' decisions will automatically affect you. And why this applies in oligopolies, because in oligopolies, firms have large market shares. So if one firm decides to change price or quantity, this will affect the profit positions of other firms. So oligopolies are inherently dealing with interdependence. When one firm makes a decision to deviate, it affects other firms. And that's why game theory is the theory we use in order to assess oligopolistic outcomes.